Welcome back to Accrued Interest. Today, March 10th, 2025, I'm going to do a vibe check where I talk about some of my broader thoughts on the market economy while we're dealing with the current sell-off in the stock market right now. As always, just want to say that everything said on this podcast is for entertainment purposes, as I am not a registered investment advisor. So the goal of this vibe check is to give you some insight into how I view the markets and the market backdrop, so you can understand where I'm coming from with my stock market recommendations and where we might go from here. At a high level, I believe that it's more likely than not the US economy probably enters a recession sometime within the next 12 months. I also think that while I'm not trying to necessarily call the bottom, and I could see the market bounce a little bit off of the current correction, I do not think the current market sell-off is a big overreaction. There actually are real, unavoidable headwinds to GDP growth that the US is going to be dealing with in 2025 and probably 2026 as well. I also want to be fully transparent in all my recommendations. Due to my bearishness, last week I sold all but 3 of my core stocks. I'm currently about 10% in net cash. I'm only looking to add to stocks that have strong organic growth profiles. The stocks I held on to during this correction are AppLovin, which I've discussed extensively, Google, because I think there's a lot of organic growth there and pessimism around the company, and Uber, which I've also spoke about on other videos. A big reason why the stock market has been selling off recently is investors all over the market have been raising the internal likelihood that they see a recession happening in the US sometime this year. I clipped this chart here from Polymarket so you can get a sense of the change in investor sentiment. We started the year where people were pretty much close to peak optimism with the new, more business-friendly administration coming in following last year's election. We began 2025 with recession expectations around the low 20%. And with the current market sell-off, the expectations are now getting closer and closer to 40%. We've also seen stock market gains since the election be completely wiped out. The S&P right now is near a 6-month low, and there's lots of debates whether or not the president is going to change his policies if the market continues to fall further. I believe a big reason why the market continues to fall further is that investors of all types and all political persuasions incorrectly assumed that the current administration was going to be focused exclusively on the stock market. Another thing that has come out that has caused many people to realize that the economic fundamentals are in fact weakening is that the Atlanta Fed surprised the market by coming out with a big negative revision to their GDP Now model. The Atlanta Fed comes out with a model called GDP Now that takes a number of different economic inputs and spits out what their run rate expectation for economic growth will be in the next quarter. We're not going to get into all the puts and takes of what goes into the model right now, but what you need to know is that over the last 2 weeks, there was a major negative revision for economic expectations for Q1 of this year. A couple weeks ago, it was expected that the US economy would have positive GDP growth of about plus 2% for Q1. In a very short period of time, there's been such a strong deterioration in business sentiment and fears around the tariffs and other economic policies that now the Atlanta Fed's GDP Now model shows a contraction. Historically, the GDP Now model has not hit economic growth exactly. It's not meant to be a precise prognosticator. But if you're watching this on YouTube, I clipped a chart that shows the historical accuracy of the model. And what is undeniable is that this model is absolutely correct in sensing changes in the direction of economic movement. I'm not the only one taking these negative changes seriously. Economists across the board also are making negative revisions to US GDP growth. I clipped a picture here of Goldman Sachs slash their 2025 full year forecast based on the negative sentiment I was mentioning before. A big thing that investors have been synthesizing is just the slew of tariff announcements and the back and forth, the uncertainty, the changes has been much worse than I think many investors expected when the new administration came into place. It is not enough to just be in an industry that is not affected by the tariffs. The uncertainty around the tariffs has put a chilling effect on business planning across the board. At the same time, trading partners to the US are also dealing with the uncertainty coming out of the current administration and are erring on the side of caution, Canada, as well as other companies, basically has stated that they're going to go to the mat for their economies, and they're willing to use retaliatory tariffs against the US should our tariffs go in place. There have been many examples where announcements of a potential tariff could be announced on a Thursday or a Friday. There can be lots of movement over the weekend, and then by Monday or Tuesday, the announcement is pushed back another 2 weeks. This is not a way for anyone to make plans, and it's entirely reasonable that businesses of all stripes are best to just sit on their hands and wait until this storm blows over. Lastly, I just want to remind people that coming to 2025, economic fundamentals, separate from all the tariffs, separate from the new administration, we're already close to as good as it can get levels. I clipped a picture right here from the US Department of Commerce. It's from 2023, but it could be applied to 2024 as well. It says that US unemployment is at its lowest level in nearly 50 years. We came to 2025 with unemployment around 4%. And if you look at the chart, you can see that anything that is below 5 to 6 is considered very, very low. So regardless of everything else, we probably were due for some weakening in the labor market. Another thing about the labor market that some might not have realized is that a big positive tailwind to the US job market and US economic growth over the past couple of years has been immigration. Economists at S&P Global, which I clipped here on YouTube, as well as other banks, have sounded the alarm that slowing immigration is going to be a headwind for U.S. economic growth. The U.S. population growth was one of the main factors that was driving growth surprises over the past couple years. I don't have strong views on what the current administration's immigration plans are going to be, but I just know they're definitely going to be more restrictive than what we've seen before. In conclusion, I just want everyone to know that here at Accrued Interest, we are not market timers. We are focused on the fundamentals, and that is the North Star that we are going to stick to. I encourage everyone to not feel pressured to try to call a bottom in this market. Don't feel like you need to catch a falling knife. It is okay to sell some stocks if you're feeling nervous and to raise cash. I would suggest you start pruning your portfolio of the more high multiple stocks that have weakening organic growth profiles for 2025 and 2026. It's perfectly fine to remain defensive. And remember, focus on stocks that you want to own for the next 2 to 3 years and not the next 3 to 6 months. As always, thank you for listening. Don't forget to like and subscribe, and stay tuned to the YouTube channel for more updates from Accrued Interest.